The statement of cash flows, remember I said that that was divided into several parts. There's operating activities, and so you start with net income and you add depreciation and increases in accounts payable, accruals, and since accounts receivable increase, that's a negative cash flow because they're not receiving that cash. And an increase in inventory is considered a negative effect on operating activities because they didn't sell this inventory. So it's like sources of cash and uses of cash. Depreciation and accounts payable and accruals are sources of cash, whereas when accounts receivable and inventories increase, that's like a use of cash because they weren't able to access it. And so operating activities provided a negative cash flow of negative 164,000. And then we have investing activities and financing activities. So investing activities was that addition to property, plant, and equipment that they used for the expansion. And so that made them have a negative cash flow there. And financing activities, you look at if there was an increase in notes payable, that means they received cash. So that's a plus. They increased long-term debt, so that's also a plus. It's because they received that money for financing. And then when they paid dividends, that was an outflow. And so you can see that if we sum, let's go back, the negative 164 and the negative 711 and the positive 825, you get a net decrease in cash of negative $50,318. The cash they had at the beginning of the year is what we looked at on the balance sheet, which was 2013, was 57,600. And so if it decreased by 50,000, that's why we saw on the balance sheet that it left $7,282. And so here we kind of have a summary about how we've looked at the statement of cash flows and what we can conclude from it. And if we look at the first item, that the cash flow from operations was a negative 164,000, and since net income was the first starting number in that, that was the main cause of the negative cash flow from operations. And we also saw that the firm had to borrow a lot of money, 836,000, to meet its cash requirements, and then even after all of that, their cash account fell by 50,000. Did this expansion create any additional after-tax operating income? And this would be taking your earnings before interest and taxes and taking out the taxes, but not considering the interest expense. So after-tax operating income, if you can see from the calculation, ended up being a negative 78,000. Now in 2013, it was positive 114,000. And then what happened to net operating working capital? And so the definition for this NOWC, net operating working capital, is current assets minus operating current liabilities. So that means it's current liabilities minus notes payable. The notes payable is not an operating current liability. So you take your cash, accounts receivable, and inventories and add them up. They're your operating current assets minus your accounts payable and accruals, which is the same thing as saying take the current liabilities and subtract out notes payable. And so you get the net operating working capital increase to 913,000 from 2013, where it was 842,000. And so here we look at just kind of a short assessment of the expansion's effect, and we see that sales doubled, after-tax operating income decreased to a negative number, net operating working capital increased, and net income decreased. So overall, this is not good information about the expansion.